Hey, in this video series that's going to drop over some days until it's complete, it's going to help you to pre-qualify for a mortgage. Now, pre-qualifying for a mortgage is not something that I do for clients. I pre-approve clients because we don't have all of the x-rays, so to speak, all of the scans. I like to say that we play doctors as lenders. So you're coming in with a bunch of symptoms, but if you don't let us run the tests, it is very difficult to give good advice, and that's why I won't do a pre-qualification. But I do realize, hey, there's a need for that. There's a need to help educate and empower people, and like I've gotten this fun little backdrop where you can figure out some DIY in it, and then you can figure out like, hey, does it make sense for me to take that step and talk to a lender like me or someone else that you trust, or maybe you just make the decision to not buy and to wait, which that's okay. That's your decision. So this first step is talking about income and what lenders use for income. For the purposes of making this easy, I'm talking about a W-2 employee. I will tell you the easiest type of employee to do a mortgage for is someone that's salary, because we take your gross income, what you wish you could take home, we divide that by 12, and that's what we use as your monthly income. Where it becomes nuanced is if you have overtime, if you have bonus, if you have commission. Now, if you have gotten overtime, bonus, or commission less than 12 months, it is almost impossible to use that income. So if you're attempting to use that in your calculations, and let me go back to what the calculations mean. So we're using gross income, what you wish you could take home as a W-2 employee. And we look at all your monthly bills that show on your credit. We look at what we think your new mortgage payment's going to be, and we divide that by your gross income. And that's what's known as your total debt to income ratio. Your housing ratio is just taking your mortgage payment and dividing that by your gross income. So a healthy number for a consumer is that you're not going above 28% of your gross income for your mortgage payment, and that all of your bills do not exceed 41% of your gross income. There's a lot of it depends answers in lending. There are times where you can go up to 57% of your gross income on some products. That's a loan where it's going to get looked at a lot with a lot more scrutiny of saying, well, is there additional income that we're not using? But for the purposes of this, let's say that you've got overtime, you've got bonus, you've got commission. As I said earlier, if you've got less than 12 months, that can't be used. So if you're using that in your calculations, know that you want to start looking for mortgage guidance, especially if you're going to be diving in and making offers when you've got 1 year or more when it comes to your bonus or your commission income. If it's 2 years, that's ideal. 2 years, we're either going to average it or use the past 12 months if it's either significantly increased, or if you've gotten any pay increases, or if there's something in your industry that shows that we can lean on more of a 12-month average. Now, as a rule of thumb for people that are relying on bonuses or commission or overtime income, if those variable types of income have nothing to do with your performance and they have to do with your employer's performance, please be careful. I'm an eternal optimist, but there's also a very cynical side of me. And I do know in business that when companies start to not do well, things that they look at is trimming the fat in the organization. The fat of an organization is typically your hourly employees, your employees that are not bringing any business or bringing any revenue to the table. They're helping get the revenue done, but what they're not doing is they're not the revenue generators, which is typically the salespeople in organizations. So if you're a W-2 employee and if your income is not tied to your performance and it's tied to the company's performance, be careful when you're doing your pre-qualification. I gave you those ratios of, hey, a healthy number is 41%, but are you heavily relying on overtime income? And I encourage you, if you are, bring that range down, or just make certain that you know what's going on in your company. Not to the point where you're getting yourself scared, but to the point where you know what, I'm a valuable employee and I'm bringing benefits to to my company, whatever those benefits may be as an employee. So the first step in pre-qualification is you want to know what your income is, and you want to know how to figure out your debt to income ratio. And there's a lot of great mortgage calculators. If you're finding this on YouTube, I've included a mortgage calculator where you can play around with numbers, try and get a sense of what your payments are. If you're finding this on one of my social channels, check YouTube if I didn't put the calculator on there. And if this is a video series that you think will help someone, please share it. Please leave a thumbs up, and please make sure to subscribe and keep your notifications open for future videos, especially on this series. See you tomorrow.